Here's a question most homeowners never think to ask. When you signed your mortgage, you were given a choice. You could make the standard monthly payments as scheduled, or you could pay a little extra each month towards the principal to pay your mortgage off faster. Almost every financial instinct you have says pay it off faster. Less debt, more freedom. Get out from under it. But for most American families, that instinct is costing them thousands or tens of thousands of dollars over the life of their loan. Today, we're going to look at the math, and by the end of this video, you may never think about your mortgage the same way again. Today's topic is one of the most common ones I see in my practice. Families who are doing everything right by saving, investing, and building equity, but are quietly leaving a significant amount of wealth on the table because of how they're handling their mortgage. Let's start with a story. Imagine two families. We'll call them the Jones and the Smiths. Both bought homes in the same year. Both took out 30-year fixed-rate mortgages at the same interest rate, let's say 4%. Both have $400,000 mortgages. Both families earn similar incomes and have similar financial goals. The only difference is one decision. The Jones decided to pay an extra $500 per month towards their mortgage principal. They've heard this is smart. Their parents did it. Their loan officer mentioned it. It feels responsible. The Smiths make only the required monthly payment, and they take that same $500 per month and invest it in a diversified, low-cost index fund. That's it. That's the only difference. Let's take a look at what happens over the next 30 years. The Jones pay off their mortgage in about 20 years instead of 30. They save roughly $104,000 in mortgage interest. That feels like a win. And in isolation, it is. But the Smiths' $500 per month invested consistently over 30 years at the stock market's historical average return of roughly 7% annually after inflation. That grows to approximately $584,000. The interest they paid on their mortgage over that same 30-year period, the cost of not paying it down early, around $287,000 on a $400,000 loan at 4%. But here's the key point. They were earning 7% on their investments while paying 4% on their debt. That spread, that gap between what their money earned and what their debt cost, is where the advantage comes from. In many scenarios, depending on the rate and the time horizon, that gap is considerably larger. This is called the arbitrage between your mortgage interest rate and your expected investment return. And it's the central concept that determines whether paying off your mortgage early is a wise move or an expensive one. Before we go any further, I want to acknowledge something, because I don't want anyone watching this to feel like they've been making a foolish decision. The instinct to pay off your mortgage is not irrational. It comes from genuinely healthy financial values, which is the desire to be debt-free, to own your home outright, to reduce monthly obligations, and create breathing room. Those are real and meaningful goals. And psychologically, there's something powerful about owning your home free and clear. No bank, no monthly payment hanging over you. That peace of mind has value that doesn't show up in a spreadsheet. But here's what I've observed working with families over many years. The families who feel the most urgency to pay off their mortgage early are often the same families who haven't yet built meaningful investment assets outside of their home equity. And that's the core problem. Because a home, while it does build equity, is an illiquid asset. You cannot spend your equity at the grocery store. You cannot draw on it in an emergency without refinancing or selling. And if something goes wrong, like a job loss, medical expense, or market disruption, equity sitting in your walls doesn't pay your bills. Investment accounts can, liquid savings can, emergency funds can. So part of what we're really discussing today isn't just mortgage math. It's the question of where your money does the most good for your family, for your security, and for your long-term financial health. Let me lay out the core equation as simply as I can. If your mortgage interest rate is lower than your expected long-term investment return, You are almost always better off investing the difference rather than paying down your mortgage early. If your mortgage interest rate is higher than your expected return or roughly equal to it, the calculation gets much closer, and other factors start to matter more. Let's put some real numbers around this. Scenario 1, a 3% mortgage rate. If you locked in a mortgage at 3% during the low rate environment of 2020 or 2021, your debt is extraordinarily cheap. The historical average annual return of the S&P 500 over any 20-plus year period is approximately 10% before inflation and around 7% after. You are paying 3% to borrow money, and your investments are historically returning 7%. Every extra dollar you put towards that mortgage instead of your investment account is in effect a 4% penalty on that dollar. Over 20 or 30 years, that compounds into a significant loss of wealth. Scenario 2, a 6 to 7% mortgage rate. This is much closer. If you're carrying a mortgage at 6.5% or 7%, which is the environment many buyers have been in the past few years, the gap narrows considerably. Investing may still come out ahead over a long time horizon, but the margin is thinner, and the emotional value of paying down high interest debt becomes a more legitimate factor. Scenario 3, an 8% or above mortgage rate. At this level, paying down the mortgage often wins, or at least ties. When your debt is costing you 8%, it takes an unusually strong investment return to beat that. And unlike investment returns, the return on paying debt is guaranteed. So the first thing I'd encourage every homeowner watching this to do is simply know your rate. Pull out your mortgage documents, find your interest rate, and then ask, given that rate, is accelerating my payoff the highest and best use of my extra monthly cash? Or is there somewhere that dollar works harder? There's one more layer here that most people miss entirely, and it's important. Mortgage interest is for many homeowners tax deductible. If you itemize your deductions, and particularly if you're in a higher tax bracket, the effective cost of your mortgage is actually lower than the stated interest rate. Here's a simple example. If your mortgage rate is 6% and you're in the 24% federal tax bracket and you're itemizing your deductions, your effective after-tax mortgage cost is closer to 4.56%. That changes the comparison with investment returns. Now I want to be precise here. The Tax Cuts and Jobs Act of 2017 significantly increased the standard deduction, which means fewer homeowners today are actually itemizing. So this benefit doesn't apply to everyone. But if you're a higher income family, or if you're early in your mortgage when interest payments are highest, this is worth understanding and worth discussing with a tax professional. The broader point is this: the real cost of your mortgage, your effective cost after any tax benefit, is almost certainly lower than the number on your loan documents. And that makes the case for investing rather than paying off even stronger for many families. Now, and this is important, I am not saying that paying off your mortgage early is always wrong. I would never make a blanket statement like that, because personal finance is personal. There are real situations where paying off your mortgage early is the right call. Let me walk you through them. Situation 1, you're approaching retirement and you want to eliminate fixed expenses. If you're 58, planning to retire at 65, and you can pay off your mortgage in that window, the case for doing so is genuinely strong. In retirement, your income is fixed. Eliminating your largest monthly expense gives you dramatically more flexibility. You can live on less, survive a market downturn without selling assets, and draw Social Security on your own timeline rather than out of necessity. For pre-retirees, the psychological and cash flow benefit of a paid-off home is often worth the mathematical trade-off. Situation 2, you have a high interest rate and refinancing isn't an option. If your mortgage rate is 7%, 8%, or higher, and you can't refinance at a lower rate, accelerating payoff becomes much more competitive with investing. The guaranteed return of eliminating high-cost debt is meaningful. Situation 3. You have no other high-interest debt, a fully funded emergency fund, and maxed out retirement contributions. If you are already maximizing your 401k, your Roth IRA, your HSA, and have 6 months of expenses in cash, then extra mortgage payments are a perfectly reasonable next step. The mistake isn't paying off the mortgage. The mistake is paying off the mortgage before you've done those other things. Situation 4. The peace of mind is genuinely worth it to you. I've worked with clients who understood the math perfectly, knew that investing the difference was likely to come out ahead, and still chose to pay off their mortgage early because the psychological weight of that debt affected their quality of life. They slept better, debt-free. They made better decisions in other areas of their finances when they weren't carrying that burden. That is a legitimate reason. Financial planning isn't only about maximizing spreadsheet outcomes. It's about building a financial life that actually works for the human being living it. The key is making the decision consciously, with full awareness of the trade-off rather than defaulting to pay it off early because it sounds responsible. If you're a family trying to figure out the right priority for your extra monthly cash, here are the steps I walk my clients through. Step 1. Get your full employer 401k match. This is a 50 to 100% instant return on your money. Nothing beats it. If you're not capturing that full match, that's where every available dollar should go first. Step 2. Build your emergency fund. 3 to 6 months of expenses and liquid savings. This is not negotiable. Without this, any financial plan is fragile. Step 3. Pay off high interest debt like credit cards, personal loans, or anything else above 7 to 8% of an interest rate. This is a guaranteed return that beats most market alternatives. Step 4. Max out your Roth IRA or traditional IRA, depending on your tax situation. These accounts offer tax advantages you can never get back once the year closes. Step 5. Max your 401k beyond the match if you are able. Step 6. After all of that, now evaluate mortgage paydown versus taxable investment account. And that decision depends on your rate, your timeline, and your tax situation, and your goals. Most families who are aggressively paying down their mortgage are skipping steps in the middle of that list. That's the real mistake. It's not that paying off your mortgage is wrong. It's that it's often happening before things that would serve your family better. Your mortgage is probably the largest financial commitment you'll ever make, and the decisions you make around it, such as how you structure your payments, where you direct extra cash, and how you think about the relationship between debt and investment, have an enormous impact on your family's long-term financial health. If you found this useful, subscribe. I publish videos like this every other week, covering the financial decisions that matter most for families and people planning for retirement. And if you're not sure whether your current mortgage strategy is working for or against your long-term goals, that's exactly the type of conversation I'd encourage you to have with myself or a financial advisor, someone who can look at your full picture and help you make the call that's right for your specific situation. I'll see you in the next video.